In this video, I'm going to do a bar by bar recap of how the day unfolded today against the value weighted average price and then its standard deviation levels. So coming in, this is the day right here. It's now unfolded and coming into the day, which would have been right here at 5 o'clock. What information would I have had available? Well, I would have had everything to the left of that available to me, and uh, every day I'm here at the monitor, and every day I'm here at the computer, and I've been trading, and this information is what I see, and this is the information that I have, and this is the information I should know, and this information gives clues towards the direction I should be trade, the bias that gives the probability of being correct, the highest probability of being correct. So, um, when the day started, I would have known the value areas for the previous day. So the previous day's value area would have been, let's see if I could do something here. Extending, and I just want to hide all of those for a moment. Because those are my levels, I don't want to get rid of them. So at the open of the day, I would have seen here that the 4 o'clock bar and the 5 o'clock bar opens, the 4 o'clock bar closes and the 5 o'clock bar opens below the developing day's value from Wednesday. And so therefore I would be opening uh, just below the value area. But more importantly, what it would tell me is that the value area is higher than the previous day. And if I zoom out, I could see that the value area here has gone, has shifted to the upside 1, 2, 3, 4, 5 consecutive days. So for 5 consecutive days, the value area, the area where most amount of trade has taken place, has shifted to the upside. That indicates to me that we're trading, the bias is to the long side. Now that doesn't mean you trade at the highs on the day. No, that means that any sort of pullback to levels that we know should hold, or levels that should give high probabilities, uh, should be good places to take short trades. So it would have been hard to potentially have done it here, though it wouldn't have been that difficult because the risk would have been low. The risk would have been stops to go anywhere where the green arrow is, because you're on the developing value area low at 7 o'clock in the evening, and then you trade to the upside. Then um, or when you see it come back, now you wouldn't look to take long trades here. You would look for, if this was going to continue up, let's say for example if that was going to continue up, then you would look for it to come back and test the developing value and then do that. But when you don't see that going with continuation up, you have to be smart about trading. You can't just because the trend is up, the bias to the upside, the momentum is strong to the upside, doesn't mean you buy the highs. You still look for pullbacks. So when you don't see continuation here, but then this bar comes back and you see it drop down to the value area low, and then it can't continue further down. You see it stops here. You have a wicks on both sides. The next bar is an absorption bar because it's an inside bar. It gets contained within the previous bar, and you're not seeing follow through. Again, this would be an excellent area on the next bar as you see that you close inside of the value area. As price starts to come down here, this would be an excellent area to take long trades. Now I know this is 2 o'clock in the morning and I'm not at the computer, but the thing is that when I do come to the morning and I'm starting to trade, this information is available to me, and again I can use it. I can use it to my advantage. I could use it to give me ideas that look, we had a move down here and we couldn't get continuation. We found responsive buying and we moved not only to the value area high, but all the way up and above it. And then when you see it come down to the developing value and to the previous day's value, and you're armed with the knowledge that look, we are doing many days here, 5 days, I think it was. 1, 2, 3, 4, 5 days of value area going up, then it's not a stretch or it's not a low risk or low probability of taking a long trade on this value area here. And if it just means take a blind trade off of the value area low and say, well, whatever happens when the bar closes, then I'll either take a loss at that point or I'll set in my stops or I'll adjust. But the hard stops would have gone down here below the lows for the day. And then early warnings would have been closed below the value area and can't get back in. But if you're taking a trade here, you in an uptrend, you buy the value area low, and the two of them were to align, the previous days and the developing day, and you buy the value area low, and within less than, in fact, I watched this and I was here live for this. Within 10 minutes, I think it was under 5 minutes or so, you were back above value here. And then when this 10 o'clock bar opens, within the first 3 minutes, you were back up. Within the first 2 minutes, I think it was, you were back up to the value area high. And so now when you see that, you're getting the signals that tells you that look, you got into a good trade here and you don't have to take a loss. So you could not bring your stop to break even, or you could bring your stop down below here and feel comfortable about it, whatever the case may be, and then you just let it sit for the rest of the day and look at that as we talk about. It's still going up. So to come back to what information do I have at the start of the day? The information I have at the start of the day is that we are trading to the upside. And if I zoom out even further, you can see that this trend is to the upside. And when when you don't buy the highs, but you buy the lows, and then you hope for the best because you've done your homework and now you just watch the levels. Now, had I even over here when I see this thing coming down, if I had bought the lows here, now I was at the computer and I saw this. If I had bought the lows here, thinking that this was gonna go up that way like it did today, then I would have been out on the next bar. Because you would say, just like I said over here, you buy it blind because when this bar opened, it didn't go down. It went within the first 15 minutes, it put in this high. It opened, did not drop at all, opened and went one direction up. And then around the 15-minute mark of the hour, it came and fell down. I know because I was at the computer, I saw that, I lived it. I was actually shorting on this bar, and I was looking for more reasons to short, but I was a little bit worried and I didn't short here. But that's not the point. The point is if I had, then I'd say, okay, when this bar closes, my stop would be, my hard stop would be, let me just move it. Let me just clean that up. Sorry. My hard stops would have been below the previous period's value area. Regardless if it just goes there and touches it, it hits my stop and runs back up, that's okay because that's how trading is. You take a chance, you get in on an entry, and you say, I'm getting in on an entry here, and I'm expecting price to go up here. And if it goes up, then I'm good and I'm a winner and I make some money. But if I'm wrong, then I'm putting my stop down here with, however many pips away from that low, and then that's my hard stop, regardless of what happens. It's my hard stop. But then when this bar opens and it comes back here and you get to break even, you get out. Because you get out because you've now come with a pretty strong bar all the way down and you've closed below the developing value. So it tells you that this value area low is in play. And if this value area low is in play, then and you know that at the end of the close of this bar, then you do, and you get a chance to get out for break even, you get out. Again, that's trading. Now trading is you have an entry and you take the entry and you say this is where I'm thinking that is a good place to start a trade, and if I'm right, this is I have a limit, and if I'm wrong, I have a stop, and then once you are in that trade, you let one or the two get hit, or you do trade management. So if you take a trade like this was a blind trade off of the value area low, and then you see it close this far away from the value area low, then if you get a chance to get out of break even before it hits your stop, that's trade management. You adjust and you get out, and that's fine if it come out and take you out for break even and then putts around here and then take off to the value area high, again, that's trading. That's fine, because if it had done that and then come, you would have got clues, the kind of clues that was evident here, and then you would say, I've got my capital free again. I'm now my mind is clear. I don't have to worry about a trade that I'm already sitting in. And my mind is free. My judgment is clear. My bias is clear, and my bias is now not what I wanted to do, but rather what the market is going to do. Got a little sidetracked here, but the point is what I wanted to make, and is what I wanted to do in the video was do a bar by bar breakdown of how price unfolded for today. But in order to do that, I needed to do the backstory or look at what's happening, and then that makes the levels more stronger to talk about. Let me bring back in here. All right, unhide, unlock. Show. Oh, there you go. Now, uh, in addition to the developing value areas and the previous day's value areas, I also have my own levels that I've put in based on where I think support and resistance will be. And I had these levels in from earlier in the week and from the homework I did on the weekend. And this low volume area here is, you see price come into an area that identify that could possibly be support, and then when you see this behavior come down and you can't get continuation, absorption, close inside of value, uh, get a bullish pin bar, and then you close inside of value, then you got to think the target is back to value area high, and maybe even higher, because this is where the trend is. Plus, you have all of this information here. The information available to me is amazingly useful uh, to to use to trade. So here I've got well, all of this is all initiative buying because we're trading above the previous day's value. Anytime you have activity above the previous day's value, you're putting in new highs. That's initiative buying. So we have initiative buying here. We have initiative buying here. Um, and then when we come down and we can't break the previous day's value here, we can't even get to the previous day's value area low. That's both responsive and initiative buying stepping in and moving price further up. So um, I started off this video wanted to talk about the individual bars, but I got into a topic that's really important to me that I need to change and for myself to get better, and that is when you take a trade, there is three elements to it. There's an entry, there's a stop, and there's a limit. And I'm pretty good now with selective entry, selecting on my entries, and I'm pretty good at selecting where the stops may be. Where I need some growth is waiting for that limit to get hit. If my stop is not getting hit, it means the limit is in play and it's chances are we'll go there. And then and not to move my stop until um, evidence suggests to do that. So, for example, if I had taken a long trade in here and my target was up here, um, then take some of it off, and then if my extended target was up to, I had this area in from earlier in the week, was up here or to the value area high, then I wouldn't move my stop up to break even or trail it until levels would have indicated. So when I see this bar come back and leave such a bullish pen bar, I don't know that it's going to continue up. I don't know. But what I could do is I could maybe bring my stop to break even or from break even to above the low, just below the lows of the 10 o'clock bar. And if I had done that, I'd be safe and I would have got a second and a third opportunity to get out these upper levels when I see that this resistance is not going to get penetrated or it's not going to get broken. And that way you could maximize your target, because what's important here is not just to be right in selecting entries or right in selecting stops. It's the third part is to be right and letting your limits get hit, because Nazar, if you don't do that, you need those winning trades that do work out to pay for those losing trades that don't work out. So winning trades serve two purposes. They pay for the losers and they allow you to grow your account. I don't think I could say it any better than that. Winners need to pay for the losers, and winners also need to grow the account. Every day I come to the market, and I'm not here for. I do enjoy what I do, but I'm not only here for fun. I'm here to earn a living, earn an income, and I need to now bring it all together. The tools I have and the experience I've got over the 4 years. There's more to learn, of course, but I should not no longer just being here for fun. It's got to be now to earn an income and to grow the account. Leave it at that.